Right guys, this video is going to be talking a little bit about business expenses, because we're going to be going into the calculation of three of the main ones that arise. Now, businesses exist to make a profit. However, the running of a business involves a lot of expenses as well. It's not going to go well all the time, and also to pay for the things that you actually sell, to pay for the labour that you incur, you need to spend money. But luckily for them, businesses, because they are hard to run, because they're so important for the economy, they're allowed to claim many of their expenses against their income, and this lets them reduce the tax they have to pay. So in this course we'll be looking at three of the main expenses: depreciation, insurance, and cost of goods sold. And I just wanted to show you how expenses are claimed and what I mean by that. So for example, if we had a business that earned a profit of 100,000, okay, that's their income, and the way most businesses, the small businesses, would be taxed would be just like individuals. They show their earnings and then they'd be taxed at a particular income. So basically they're gonna based on their income, so basically going to lose a percentage of their income to tax. Big companies are taxed at a straight 30%. So how about we pretend that the business we're calculating is a company, so that we've got a nice 30% level there. This is not to scale. So if they're taxed 30% on that income, 30,000 of it would go to the government. 30,000 tax, and this is 70,000 profit after tax. Now this is with no expenses claimed. But businesses are able to actually claim their expenses that they use to keep the business going. So regular things like wages, rent, their insurance, council rates, electricity, that sort of thing. They're able to claim that back against their profit, which effectively reduces their profit, so they're taxed a lower percentage. So let's say we had another the business this time decides to claim back some of their expenses. So say they earned $100,000 and they had expenses, I'll just make these up, actually I get them from the book, wages of let's say 20,000 wages. That's a constant regular payment that they have to pay to keep the business going. Let's say a rent of 10,000 per year. Let's say they had to pay 2,000 electricity, and yeah, those keep going. Like I said, it can be electricity, telephone, advertising, depreciation of equipment, any interest they have to pay. But we'll just go with the wages. We'll just go with the wages, rent, and electricity for now. So those expenses total to 30,000, 32,000 total. So if they claim those expenses against their 100,000, then they're actually left with 100,000 minus 32,000. You'd have 68,000 left over as their profit. So I'll try and show that there. It's not to scale, so deal with it. $68,000 in profit. Now, considering these expenses here. So again, they're going to get taxed. We're going to say it's going to be 30% again, as it's a company we're pretending, but in real life it was a small business. Their tax bracket is actually based on how much they earn, so it could well be a lower percentage, but we're ignoring that for now to make the example a bit easier. So let's say they're getting taxed 30% of the 68,000 now. which is their profit after expenses have been claimed back on it. And just let me work out what 30% of 68,000 is. 0.3 times by 68,000. So you end up with 20,400 tax to pay when they've claimed the expenses against their profit. So as you can see, it's in the business's best interest to claim those expenses back, so it reduces their profit and their tax liability. Okay, and then it's also in the business's best interest to make sure that they're not actually having too many expenses, so that they don't actually make a profit. Alright, so the next video is going to be about one of these expenses, depreciation, because you need to know how to calculate those. So hopefully it makes sense why expenses need to be considered and why they're important for tax purposes.